TSS and BTE have joined forces.
Context.
Power.
Edge.
The new paradigm of trading.
You know, there is this very specific feeling you get when you're walking out onto a frozen lake in the dead of winter.
Oh, yeah. I know exactly what you mean.
Right. Like you look down and the ice just looks perfectly smooth. It looks like it's made of solid concrete.
You feel like you could drive a truck right across it.
Exactly. But then every few steps, you hear this deep, echoing, violent crack somewhere far underneath the surface.
Yeah, and you can't see the danger at all.
Right. You can't see it, but the math in your head is telling you that something somewhere down there is under immense pressure.
Well, that tension between surface level calm and subterranean chaos, that's honestly the perfect lens for the financial markets we're looking at today.
It really is.
Because the surface looks pristine right now, but the structural integrity underneath is being tested in ways we just haven't seen in years.
So welcome back to another deep dive. If you've been, trying to make sense of the ticker tape lately and feeling like the numbers just aren't matching up with reality, you're definitely not alone.
Not at all. We're looking at a market environment that basically defies traditional logic.
Yeah, so to figure out what's really going on beneath the ice, we brought a stack of daily market intelligence from SpotGamma.
Right, we're going through their AM and PM briefings from June 1st to June 5th, 2026.
Exactly. Tracking option flows, dealer positioning, all the macro catalysts. And the core mystery we need to solve for you today is this. How exactly is the S&P 500 hitting a record-tying 9-day winning streak, floating humbly at all-time highs, while underneath the surface, every major risk signal is flashing a giant neon red alert?
I mean, you've got crude oil spiking, crypto crashing, major tech earnings bombing.
Right, it's just red flags everywhere. Okay, let's unpack this, because nothing about those two pictures makes sense together.
Well, the market is currently caught in this massive tug of war. On one side, we have extreme, historic, single-stock euphoria.
Okay.
And on the other side, we have these massive index-level shock absorbers that are basically artificially suppressing volatility.
So if we're going to understand why the index is sitting at record highs, I guess we have to look at the engine driving the whole thing first.
Yeah, and the data points to extreme single-stock call buying.
Yeah.
The market is just completely obsessed with this AI or bust mania.
I mean, the sheer scale of the volume flowing into individual AI names is just staggering.
Staggering is the right word. Let's look at Micron, ticker MU, as an example.
Yeah, let's talk about Micron.
On a single Friday during this stretch, Micron traded $8 billion in options premium.
Wait, $8 billion just in premium?
Just in premium.
We need to pause on that for a second because a number that big almost loses its meaning, When we talk about premium, we aren't talking about the value of the stock being traded.
Exactly.
We're talking about the actual cash paid just for the right to buy or sell the stock.
Right, which means the underlying notional value, like the actual amount of stock those options control, is magnitudes larger.
That's
To put it in perspective, the money flowing through options for that one single memory chip maker was nearly larger than the trading in SPY and QQQ combined.
Wow, so one single stock eclipsed the two largest ETFs tracking the entire U.S. economy.
Exactly.
It makes me think of, like, a basketball team where one superstar is out there scoring 100 points a game.
Taking every single shot.
Right, taking every shot, playing all 5 positions, while the rest of the team refuses to even leave the locker room. I mean, it works as long as the superstar doesn't sprain an ankle.
That's a great analogy. And that kind of concentrated superstar behavior has a really dark historical precedent.
It's like the ghost of 2024, right?
Yes. The data specifically highlights the parallel to July 2024. Because the last time we saw this exact type of rabid, concentrated options demand was with NVIDIA back then.
Oh, I remember that.
Yeah, NVIDIA options premium eclipsed the broad market ETFs. And the market structure simply couldn't support that much weight on one pillar.
Right, and what followed was a violent unwind. We saw a 10% market correction leading into August 2024, and the VIX spiked over 60.
Exactly. And we can actually quantify how warped the market is getting right now by looking at a metric called the CBOE Dispersion Index, or the DSPX.
Yeah, let's talk about the DSPX. The readings for June 2026 just hit the third highest level ever recorded.
What's fascinating here is that dispersion is a crucial concept to understand. It basically measures how much the individual stocks within the S&P 500 are moving independently of the index itself.
So a high reading means the underlying stocks are just swinging wildly in all different directions.
Right, even if the index isn't moving at all. And the only other times dispersion was this high were during the COVID crash in 2020 and the tariff shocks in 2025.
But the psychology behind those events was totally different, wasn't it?
Oh, completely.
Because during COVID or the tariff trade wars, there were obvious broad winners and losers across all sectors. I mean, entire global supply chains were getting repriced.
Exactly. But this time, the volatility expectation isn't about a global macro event at all. It is purely focused on the semiconductor and AI supply chain.
Which brings up, an inherent contradiction. The market is pricing in massive, violent moves for these individual tech giants, but just brushing off the systemic risk to everything else.
Right. It's AI or bust.
But this is where I have to push back on the premise a little bit.
Okay, go ahead.
Because if dispersion is at historic highs, and everyone expects these single AI stocks to move so wildly, and they're pumping billions into call options, why isn't the overall market swinging just as violently?
That's the million-dollar question.
Right. Like if Micron and the AI darlings are throwing their weight around, why is the S&P 500 just calmly inching up day by day?
Well, the answer comes down to market mechanics, specifically the physics of dealer gamma and delta hedging.
The invisible force field.
Exactly. This is the force field keeping the S&P 500 frozen upward.
And the data on this is wild. I mean, the S&P 500 tied a record going all the way back to the year 2000, 9 consecutive up days.
But the magnitude of those up days is what makes this so bizarre.
Yeah, explain that, because a 9-day winning streak should theoretically yield a massive return.
Right. Historically, yes. When the S&P rallies for 9 days straight, total gains usually hit 6.5% or even 10%.
Right.
But this June 2026 streak only yielded a total gain of positive 3.5%. It is a record-breaking crawl.
So what does this all mean? We have an engine revving at 10,000 RPMs, but the car is moving at 5 miles an hour. Why is the index completely disconnected from the momentum of its underlying stocks?
Because of what institutional traders and hedge funds are actually doing to finance their AI bets.
Okay, so follow the money.
Right. They are aggressively buying single stock calls, chasing the upside in names like Micron. But to fund those expensive premiums or to hedge their overall portfolio risk, they are systematically selling S&P 500 index calls.
Oh, wow. So they're betting the individual stocks will explode upward, but simultaneously betting the overall market will stay flat.
Exactly. And that behavior drove the one-month correlation metric down to 6.3, which is the lowest level since July 2024. Stocks are just ignoring each other.
But how does selling index calls actually freeze the market? Like, what's the physical mechanism happening there?
It all comes down to the market makers, the dealers who are forced to take the other side of those trades.
Right, because for every seller, there has to be a buyer.
Exactly. So when a hedge fund sells an SPX index call, the dealer buys it. This leaves the dealer holding what we call positive gamma.
Positive gamma. Okay, break that down for us.
Because the dealer is now holding a long call option, they make money if the market goes up and lose money if it goes down.
Right.
But market makers aren't in the business of directional gambling, They just want to collect transaction fees and keep their books perfectly neutral.
So to stay neutral, they have to constantly hedge against the options they just bought.
Exactly. Which is the opposite of what retail traders do. If the dealer holds a call option and the market starts to drift upward, their position becomes too heavily exposed to the upside.
So they have to sell to balance it out.
Yes. To neutralize that, the dealer actually has to sell the underlying S&P 500 index. And conversely, if the market dips, the dealer loses upside exposure, so they are forced to step in and buy the underlying index to rebalance.
Buy the dips, sell the rips.
Exactly.
I always like to think of positive gamma like bowling with the bumper rails up.
Oh, I like that.
Yeah, like you can throw the ball as hard as you want, you can have an earnings shock or geopolitical news, but every time the ball heads for the gutter, it hits the bumper.
Right, and in this case, the bumper is the market makers mechanically buying the dip to hedge their books.
Exactly, and every time it heads for the opposite gutter, they sell the rip. It forces the price right back to the dead center of the lane.
Well, the data shows those bumpers were incredibly thick this week. SpotGamma noted they were concentrated heavily between the 7,500 and 7,600 levels on the SPX.
And there was a perfect example of this on June 3rd.
Yeah, SpotGamma tracked this mechanical trampoline in real time. The market started to slide in the morning, and it dropped down to 7,550, which their models had mapped out in advance as a major hedge wall.
Right, I remember seeing that in the daily briefing. It was flagged as a seek and destroy target.
Because the market naturally seeks out areas of high liquidity, At that exact 7,550 level, traders stepped in and sold roughly 15,000 0 days to expiration, or 0 DTE, put options.
Wow, 15,000. Okay, so apply the market maker logic to that.
Right, when customers sell puts, the dealers are forced to buy them. Buying a put means the dealer now profits if the market falls.
So to neutralize that downside exposure.
The dealers are instantly forced to buy the underlying S&P 500 futures. That immense wave of forced algorithmic buying acted as a trampoline. The market hit 7,550 and immediately bounced back up.
The bumper rails did their job. I mean, they kept the winning streak alive without letting volatility break out.
Exactly.
But here's the thing about bowling bumpers, they're just plastic. They can only take so much blunt force before they snap. Which brings us back to the cracks in the frozen lake. Because while the index looks incredibly calm, the macroeconomic forces trying to pull this market down are getting heavy.
Yeah, the underlying foundation is facing severe headwinds, and these run directly counter to the AI or bust narrative.
Let's start with crude oil.
Right, oil climbed back over $90 a barrel this week, eventually hitting $96 amidst fears that an iron deal just wasn't going to materialize.
And anytime oil spikes like that, the specter of sticky, stubborn inflation comes right back into the room.
Exactly.
And if inflation stays sticky, the Federal Reserve can't cut interest rates, which fundamentally pressures the exact tech stocks carrying the market right now.
And it wasn't just oil flashing red. Crypto took a massive hit too. Bitcoin suffered a 15% drop over just 3 days.
15%? That's brutal.
Yeah, and if you look at IBIT, the Bitcoin ETF proxy, the models noted it fell deep into negative dealer gamma territory.
We should define that, actually, because negative gamma is basically the evil twin of the bumper rails. If positive gamma is a trampoline, negative gamma is a trapdoor.
That is the perfect distinction.
So how does the trapdoor work?
Well, when an asset falls into negative gamma territory, the dealers are holding positions where they are short options. To hedge a short options book in a falling market, the dealer actually has to sell the underlying asset as it drops.
Oh, so selling begets more selling.
Exactly. The bumpers disappear, and the hedging mechanisms actually accelerate the crash. That is exactly what we saw playing out in crypto.
But the most dangerous cracks didn't appear in crypto or oil, did they? They appeared in the very foundation of the AI narrative itself.
Right. We saw earnings reports from Broadcom and CrowdStrike.
And these are absolute pillars for the semiconductor and software sectors. I mean, they are the companies actually building the infrastructure for the AI revolution.
And their earnings were violently rejected by the market. Broadcom dropped 14%. CrowdStrike dropped 9%.
That's a huge reaction.
In a normal market, a slight earnings miss might cause a small pullback. But because so much premium is baked into these names, the market's tolerance for anything less than absolute perfection is just gone.
So this leads to a really interesting question. If the superstars are suddenly missing their shots, the capital has to go somewhere, right? The smart money isn't just going to sit in semiconductors and wait for the floor to fall out.
If we connect this to the bigger picture, we saw a distinct tactical rotation begin to play out beneath the surface of the index.
Where was the money going?
Well, money started flowing out of the semiconductor ETF, which was down 1.6%. And we saw capital quietly moving into financials, with XLF up 2.6%.
Right. Blackstone broke above key gamma strikes, surging over 7%.
Exactly. Healthcare started catching bids as well.
This is where looking at options flow data becomes incredibly valuable, because it shows you what institutional money is actually doing, not just what they're saying on TV.
Absolutely. The intelligence tracks some massive, weirdly specific wins in niche markets outside the main tech bubble.
Yeah, let's look at the Flow Patrol data. We're talking about Applied Optoelectronics calls up 25% for 2028 expirations.
Right.
We're talking about massive buying of puts on software ETFs, up 30%, and heavy call buying on the Brent oil fund, up 20%.
Those tactical flows tell a story. Institutional managers are quietly buying long-term insurance against the software sector. They're betting heavily on long-term physical infrastructure. And they are riding the commodity spike.
They're hedging their bets.
Yes. They are fully aware of the fragility of the S&P 500, and they are hunting for alpha outside the AI blast radius.
Which makes me look at this whole picture and ask, if Broadcom and CrowdStrike are suddenly getting punished, and oil is spiking, and the smart money is buying software insurance, doesn't the AI or bust narrative suddenly lean dangerously toward bust?
The heavy hitters certainly think it's a distinct possibility, which is why we're seeing them brace for impact. The ticking clock is getting louder.
So how are they bracing?
Well, the daily briefings are outlining exactly how the smart money is positioning for the ice to break. They are building their lifeboats.
Because the S&P 500 correlation dropped so low, index-level volatility became artificially cheap, right?
Exactly. The VIX was suppressed. So the recommendation in the SpotGamma briefings was to load up on defensive plays while they're basically on discount.
They pointed toward adding downside protection via July SPY put spreads and June VIX calls.
It is the equivalent of buying fire insurance for your house while the living room is technically still intact, simply because the insurance premiums happen to be at rock bottom.
Yeah, that makes a lot of sense. And more importantly, they drew a massive line in the sand, the ultimate tripwire for this market. They call it the risk pivot.
The risk pivot for this specific week was established at the 7,490 level on the S&P 500. This is the crucial number to understand if you are navigating this terrain.
7,490.
Yes, the models show that as long as the market stays above 7,500, the market maker's positive gamma will contain the selling. The bumper rails are up.
But if the macroeconomic pressure, the oil spikes, the tech misses, forces the index below 7,490, the math flips.
The math flips violently. Below 7,490, the entire market maker complex transitions from positive gamma to negative gamma.
The bumpers disappear.
The trapdoor opens, and dealer hedging will force algorithmic selling into the weakness. A break below that level signals a much larger structural decline.
And looking at the calendar, the path to navigating around that trapdoor is just a complete minefield.
Oh, absolutely.
I mean, you have non-farm payrolls, the major jobs data hitting on June 5th, you have CPI inflation data on June 10th, you have a massive options expiration event on June 18th.
Any one of those could provide the macro shock needed to push the market down.
It creates an incredibly tense dynamic. Traders are currently using 0 days to expiration options to hedge day-to-day.
Right, the zero DTE options. By heavily trading options that expire on the same day, institutions are temporarily compressing volatility in the present moment. They are pinning the market in place.
It makes me think of a stretched rubber band. Like they're selling daily options to tightly grip the rubber band today, but the tension doesn't disappear, it just gets transferred.
Exactly. The longer dated options further out on the calendar are pricing in a violent snapback. The daily flows are masking deep long-term anxiety.
Right.
And while inflation and jobs data are obvious catalysts for that snapback, the models specifically circle an entirely different event as the potential pin to pop the bubble.
Here's where it gets really interesting. What's the event?
June 12th, the SpaceX IPO.
Wait, really? The SpaceX IPO. This is where the narrative shifts from market mechanics to market psychology. Why would a space exploration company going public threaten a stock market held up by semiconductor chips?
We have to look at the concept of liquidity and narrative capture. For the last 2 years, the only narrative capable of absorbing massive amounts of growth capital has been artificial intelligence.
Okay, that's true.
AI, or bust, became a self-fulfilling prophecy because there was no alternative vision for the future competing for those institutional dollars.
So it became a closed loop. If you wanted growth, you had to buy NVIDIA or Micron or the infrastructure supporting them.
Exactly. And that concentration of capital is what built the massive gamma shield we've been talking about.
But the SpaceX IPO isn't just another tech listing, is it?
No, it represents an entirely new, massive paradigm for growth capital. Interplanetary infrastructure, satellite networks, space logistics.
And the sources circled this.
Yeah, the implied volatility in the options curve naturally begins to rise just beyond June 12th. The market isn't just pricing in a stock offering, it is pricing in a macroeconomic shockwave.
Because if a massive multi-billion-dollar alternative to AI suddenly appears on the board, the capital has to come from somewhere. I mean, institutional funds don't have infinite cash.
Exactly. To buy into the SpaceX revolution, they will have to sell their winners, they will have to liquidate their massive positions in the semiconductor and AI names.
And when they begin to liquidate those positions, the concentrated options premium disappears. The single stock gamma engine that has been dragging the S&P 500 upward basically stalls out. And if the AI engine stalls, the S&P 500 stops inching forward. If the S&P 500 drops just a fraction of a percent and breaks below that 7,490 risk pivot, the positive gamma bumpers evaporate.
The dealers switch to negative gamma.
And suddenly the trapdoor opens. I mean, the rotation of capital out of AI and into space tech could be the exact mechanism that breaks the ice.
It is a systemic vulnerability that the options market is already quietly bracing for.
Wow. This entire week just serves as a masterclass in why you cannot just look at the surface of the index and assume the market is healthy.
You really can.
In a market totally consumed by euphoria, it's the hidden mechanics understanding things like delta hedging, the extreme dispersion index, and the exact location of that risk pivot that will save your portfolio.
Yeah, knowing those mechanics is really the only thing that separates reactive panic from a prepared, calculated strategy.
We know that AI or bust narrative is the only thing keeping the index afloat right now. We know the gamma shield is thin and the macro pressures are building.
Yeah, the record books say the frozen lake is solid.
But if you listen closely to the data and understand the structural pressures underneath, you can hear the ice cracking. So what happens to that precious liquidity on June 12th when SpaceX hits the market? Could that be the exact pin that pops the bubble? Keep your ears open and keep your eyes on that pivot. Thanks for joining us on this deep dive. We'll see you next time.